Members and guests, my name is Tim Sullivan with Clarity Financial in Columbia, Missouri. It is my honor and great pleasure to introduce our next speaker today and guest, who truly needs no introduction, especially to this audience. John C. Bogle is the longest-serving leader in the U.S. mutual fund industry. After graduating from Princeton University in 1951 with a degree in economics, he joined Wellington Management Company. In 1974, he founded the Vanguard Group, serving as chief executive and then senior chairman through 1999, and since then as president of its Bogle Financial Markets Research Center. In 1975, he founded the world's first index mutual fund, with current fund assets under management totaling some $3 trillion. Vanguard is the largest mutual fund organization in the world. In 1999, Fortune magazine named John one of the investment industry's 4 giants of the 20th century. And in 2004, Time magazine named John one of the 100 most influential people in the world. He is also a prolific writer and speaker. As we are gathered here today in the city of brotherly love, please help me give an extremely warm welcome to Mr. Jack Bogle.
Well, it was good being with all of you today. See you later. I have to laugh. It left me kind of thrown off the last time this happened. I happened to be speaking at the NASD, talking about things that needed to be done, and they had a huge crowd, maybe not quite as big as this one, to be honest, but the NASDAQ, whatever it's called, the regulatory thing that's now blended in with the New York Stock Exchange, for the financial regulatory, whatever it's called now, and they gave me a standing ovation down there before I started to talk. And I'm thinking, what the hell's going to happen when I'm through talking? So I'll worry about throughout this session. But I'm delighted to be with all of you. And this is actually, in many respects, sort of a nostalgic day, because right catty-corner to this hotel is the building that I worked in from 1954 to 1974. The headquarters of Wellington Management Company. And we were a little company. One of the highlights of my tenure there was one Saturday morning I came in with our great founder, Walter Morgan, and was allowed the great privilege of opening the front door when our important visitor came and welcomed the Duke of Wellington into our headquarters. Yes, there is still a Duke of Wellington. And so that was, I'd been assigned many important responsibilities along my life. That was probably the biggest one. But we worked there, and in 1974, a whole lot of bad things happened. Before I get to that, however, I want to tell you why I'm here today. And it is kind of crazy, but on May 15th, probably May 18th, on May 18th, I got a letter dated May 15th, a little handwritten letter to my home. And my wife said, "How does anybody get your address?" Well, I mean, I hate to tell you, Eve, but it's pretty easy. And I basically am very discontent and very negative in feeling when I get a letter at home, because not to say it's a little bit of a tiny intrusion on my home life, which business is bad enough to do, but it's also a filing menace. Because everything that comes into the office, Emily makes 4 copies and puts one here, one here, one here, and one there. And eventually, maybe some months later, everything gets answered, and we know it's there. But something to home, if I leave it at home and they get lost, and you'll never hear from me again, Tim. Sorry about that. So I read this letter, and it was a handwritten letter. Tim Sullivan had a beautiful calligraphy kind of style, writing style. Actually a little bit like I used to have about 80 years ago. And he made this proposal that I come and address you. And he, pretty clearly a young guy just coming into the business, and I always admire that and like that. That gave me a positive reinforcement. And I've always liked the financial planning field, particularly the fee-only field, as a natural partner for Vanguard. And as our low costs, the typical planner, of course, is charging a flat percentage fee, maybe not the best. I know your views on that. And so it seemed like a natural fit. And I asked him if he could arrange so I can get out of here. My wife doesn't like me to come home late, by which means if I get in after 4:30, I'm going to be in a little bit of trouble. I work shorter days than I used to. Don't get in the office now, and then leave home about 8 and work till about 4:30. And that's long enough at my age, quite long enough. So I didn't know if I could do it, but he organized it. Tim did, and I thank you. You all did, for making it possible for me to get home even a little bit earlier than usual today. So it's great to be with you, and it's an honor for me to be with you. And as I read Bert's book, which I do have right here, I took care of it, Bert. Little plug, if you've never seen the book before. Always trying to help, and respect the audience. But thanks to Tim and his kind of low-key way of writing, we erased the big debit that was getting a letter at my home, and gave him a big credit for the way he presented everything. And so I'm very happy to be here, and no one dragged me kicking and screaming here. I was eager to do it. And also I met Chip yesterday out at Vanguard, so I've had a previous meeting with him. We had a nice discussion out there. And the only other person I want to recognize here, unless he walked out on me already, is my wonderful assistant, Mike Nolan, who helps me get everything done at the Bogle Financial Markets Research Center. Are you there? All the way back there, Mike? Do you think you're going to have to run for it, or? Now pay attention. So it happened that just before we had left that building to move out to the suburbs, and I was the president of the Wellington Management Company, and we were still distributing, as we had been since 1929, Wellington Fund shares through stockbrokers. Long history of working with the brokers, talk to them a lot, Dealers Digest conventions, those kind of things. And that was one of the things I did. It was a very small company, and I had the opportunity to do many, many different things. But it was a broker-oriented distribution force, a load force. What do we say? A seller-driven and not a buyer-driven distribution system. So I had done this utterly idiotic merger in my job. I became head of Wellington Management Company a few years, well, back in 1967, actually. And it was the go-go era, and the era where stocks, worthless stocks, were bid up to ridiculous prices. And that kind of collapsed. It was succeeded by, if you know your financial history, by the favored 50, or what was called in those days the Vestal Virgin era, where everybody owned the great 50 stocks. IBM, Xerox, you can go right down the list of the big stocks of the day, and didn't care what price they paid for them. They were good companies, but people paid ridiculous prices for them. Those two things collapsed, and I had done a merger basically to protect Wellington Management Company from a marketing standpoint with this go-go group from Boston, and they failed us at every single level. They were the investment managers. They ruined Wellington Fund, their own fund called iVest, now gone. We went down 75% in a 50% market decline, and they started two other funds, which I won't bore you with, but they also came and went like so many funds in this crazy business do. And so we were in terrible shape. Our assets dropped from about 2.9 or $3 billion. Can't keep those damn trillions and billions straight. To about 1.4 billion. The company's earnings faded away. It was a publicly held company, which is something I have never liked, but I inherited that. And they fired me. They fired me. Don't always expect justice in the world. And I considered it my company. I was the chief executive, and I'd done this merger and given them a little more stock than I should have. I'm very naive politically in those kind of things, and I was out of work. And so I decided to fight a battle, to have the funds. I was also in this funny business, not just the president of Wellington Management Company and the chairman, but the president and the chairman of all the mutual funds. And I decided to fight a battle with the mutual fund board, a little bit different from the board of the management company, and have the directors get themselves in a position where nobody could ever fire their chief executive again. So we created a position where the head of the funds Nobody in the industry does it this way, where the head of the funds comes into power and can tell the management to do anything. And I did. And it was a very difficult thing to pull off, internal management. A mutual company, that was the big catch, the big thing for the directors, to create a new kind of company that would operate at cost for its shareholders and not for its managers. And I'd written about that in my senior thesis at Princeton, which was on the mutual fund industry. The economic role of the investment company was called. And I believed it then, and I finally had an opportunity to put it to work, and also immediately an opportunity to start the first index fund. We had the structure in Vanguard, and the index fund fit that structure perfectly. Very low cost was going to be the big difference. And so we started the world's first index fund as the best strategy to go with that sound structure. And I've said 1,000 times, I guess, strategy follows structure. And that's all we bring to the table. Low cost, indexing, and relative predictability for all the other funds. Even the funds that aren't indexed have very heavy index components. And so we were on our way just 40 years ago. And in a peculiar, as the Brits would say, in a peculiar fortnight, 2 weeks, all the ingredients of today, Vanguard today, were put into place. We were incorporated on September 24th, 1974. We had picked the name which the directors hated. And the only reason I was able to get the name Vanguard, you know, you give a guy like Bogle a name like Vanguard, and you know he's going to run with it. He's that type of guy. And they didn't like it, but we got one swing vote to vote for it. Everything was this way in those days. Because someone said, I said, thinking of some way to get the board off the dime on this one, I said, and furthermore, since we've been identified as the Wellington Group, if we use the name Vanguard, it will be in the same place in the Wall Street Journal and the New York Times, and therefore the shareholders will know exactly where to look. And one of the directors said, who was against the name, said, oh, I think that's really important. I'm not, you couldn't make these stories up. I could spend the rest of the week telling them. Everything decided that way. And so the event number one was naming and starting Vanguard. Within about 7 days or 8 days, out came the first edition of Journal of Portfolio Management, and in came an article from the great economist, Nobel laureate economist Paul Samuelson, in that first edition on my desk, and he says, somebody please start an index mutual fund. It's called Challenge to Judgment. And he didn't need to persuade me about the merits of indexing. I'd mentioned it in my Princeton thesis. I'd done some research on it. But I had no credibility with the board. The board was very divided. This is the fund board, because my rivals were smarter than I was about putting their people on. I never did that. And so I knew that he had given me the intellectual endorsement. So when I say to the directors, we really need an index fund, they would probably say, what the devil do you know about it? I'm not kidding. And so that article by Paul Samuelson was marked Exhibit A in my presentation to the board for the intellectual credibility. And then 3 days after that, one of the great blessings of all time, 50% market decline that began at the beginning of 1973, ended on October 5th, I think it was, or 7th of 1974. So we had the opportunity of a lifetime to really build something new from an industry that was thrown backward on its duffel bag. And industry assets in that big market decline would go down from, I think the number is about $56 billion to about $30 billion, about a 40 or 45% drop in assets. The industry was hopeless. They weren't selling management companies, they were giving them away. And most of them were beginning to become publicly held. So it was a deeply hidden, I admit, opportunity to make maybe to give a try at changing the world of finance. And so we did, and it all happened that little fortnight, as the Brits say, 14 nights. And a little bit of financial history took place in that short period of time. Luck, 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 and luck. Born of stupidity, because that merger that I did was so stupid, so naive, so ignorant of the lessons of history, which I knew perfectly well. And you know, the deal, the big deal, and it would be good for Mr. Morgan, who owned most of the stock of the management company, because it would make it more valuable, and it did for quite a few years. And then it all fell apart too. So that's the beginning. We had you know, wonderful tribute to my foresight after this big breakup. And we had about $1.4 billion of assets in the funds that had been at Wellington, mainly Wellington Fund. And investors took out $300 million in the next 3 years. Dice vote of confidence from those who knew best. And then Forbes magazine capped the climax by having a nice article about this new company and this separation called A Plague on Both Your Houses. It's out of Shakespeare, for those of you who don't know it. Romeo and Juliet. By the way, they did apologize twice. Once 25 years later and once 31 years later. And actually, that's the truth. I may have the years a little bit off, but it took a long, long time. And the next thing we did is realize what we'd known from the beginning, that you can't really have an 8% sales load in a broker-dealer distribution system if you're going to become the lowest cost provider from an expense ratio standpoint in the business. So we eliminated all sales charges overnight. Another fight. I mean, if you like the idea of Vanguard, you're going to love the fact that I am a fighter. I love a good fight. I'd almost pick one if I didn't need to. So I think, and here we are today, $3 trillion, an 18% market share, which no one's ever been anywhere near before. The highest, you know, is first Mass Investors Trust, then Investors Diversified Services, now called Columbia, then Fidelity, then Vanguard. And they all stopped out at about 15% of assets. And they're all shrinking now hugely. MIT, Mass Financial, has gone from a 15% share to 1% share. And Fidelity, do I dare mention that name here? Used to be $200 billion ahead of us, and now they're $1 trillion behind us. So let me just try and get the braggadocio out of this and say $3 trillion does nothing for me. Nothing for me. I'm much more in this business for the human beings that I work with and the human beings that we serve, and for that matter, the human beings in your alliance in this room. People mean a lot to me. I said in one of my messages to the crew, I like people more than I like algorithms, which puts me totally out of step in this era. But so let me be very clear on that I'm not really bragging. In a certain sense, I'm complaining. And in a Q&A session not so long ago, well, $1 trillion ago, that was 2 years ago, someone raised a hand and said, "You must be very proud of having crossed the $2 trillion mark." And I looked at this gentleman and I said, "Look, what do you think $2 trillion means to somebody who's written a book called Enough?" So with that, I'll turn it over to you, Chip.
Okay, working?
Yeah, you should be okay.
Yeah, okay.
I'm in charge of the technology here.
Got the wrong? Oh no, I didn't flick the switch. Excuse me. Thanks, Jack. So just Chip Simon from Poughkeepsie, New York, Taconic Advisors, and as Jack mentioned, I had the extreme pleasure of taking a tour over at Vanguard yesterday. And by the way, if you want a perfect example of extensive branding throughout your organization, the nautical theme from his own interest in nautical history carries throughout. He mentioned the word crew. They don't have employees; they have crew members. You eat in the galley. Maybe they call the food grub. I'm not sure. But wherever you go throughout the campus, you see this throughout. And so it's branding way ahead of its time. Way ahead of its time.
The ship-shape room.
The ship-shape room.
That's our, like, Jim thing.
Exactly.
My wife said, "Don't you think you're going to run out of nautical metaphors?" I said to her, "I'm afraid not."
So Jack, let me ask you, you probably have a few opinions about just financial products in general in the financial services industry. Care to share any of those?
Well, it's an industry that is not an industry I'm happy with. I think we've been too much focused on the manager's interest rather than the interest of shareholders. I think Wall Street is a bad joke. When you think about what goes on Wall Street, I've used this example before, what happens in Wall Street? Well, in kind of the ultimate kind of rationale for Wall Street is by providing new capital to growing businesses, it greases the wheels of capitalism. And that's what everybody says, right, left, and center. So how much do they do of that? They do about $250 billion of new equity capital a year. What else do they do on Wall Street? They let us trade with each other, or encouraging us to trade to the other, to the tune of $34 trillion a year. So raising equity capital is approximately 0.4% of what Wall Street does. And the rest of it, all that trading, everybody must know, gets nowhere. I mean, you may win and somebody else loses, and then they may win and you lose, but it's a closed circuit. And all it does is enrich the croupiers, the guys that are raking in all the money out there on Wall Street, just as they do in Vegas, Las Vegas, whatever it's called. So it's also been a business that has been much too much based on new products, a word I banned at Vanguard a long, long time ago, because I don't think we should be in this business selling products. I think we should be in this business providing trust services. And I say, look, selling products is great for beer, great for Colgate toothpaste, I should say Budweiser beer maybe, and one of the great marketers for one of the poorer beers around, I think. Never underestimate the value of marketing. I hope I haven't offended anybody. Diamonds, automobiles, the whole deal, they're all products. We've gotten into a new product thing, and then complex new products that came out, all those collateralized debt obligations, where the lenders lost all interest in, the borrowers lost all interest in the lender's credit because they were selling the loans to somebody else, and they didn't have any, didn't matter to the banks how much, whether the borrower had a lot of credit, because someone else took the loan. And so all those kind of complex things, derivatives, instruments of mass destruction, according to the great Buffett, and he proved to be right, of course, as he usually does. And so it's gone from 2% of our economy, maybe in the 1940s, to about 8 or 9% now. And the financial system is simply too big. It needs more people doing service to investors and less people doing marketing. And in the mutual fund industry, which I also have a big problem with, we've taken and I was in the business then, we've taken a nice little profession, very professional in orientation. The funds were organized and operated usually by investment professionals, and so it was run largely as a profession, and now it is run largely as a business. And it's not about management anymore, it's about marketing. And it's not about stewardship anymore, if it ever was, but it was a little bit. It's now about salesmanship. And none of this serves the clients. And ultimately, the clients have to be served for a business that's it's going to take a long time to get this across. But I think groups like yours and people like you are perfectly capable of being a great place to begin all that. And the Vanguard mission certainly is, I'm not sure anybody can articulate it very well among our shareholders, but it's basically a client-based service. If you build it, they will come. And they did.
Mr. Bogle, you established a certain culture at Vanguard in the years that you were there, and I was speaking with Mike about this before we came on. Is that culture still alive and well? And as you know, as companies grow to a certain size, it becomes more difficult to maintain that culture, but also just with new management, that becomes more difficult also. So is the essential culture that you established originally, is that still alive and well at Vanguard?
Ask me an easy one. The answer to that is, yes, it's alive, but it's tested almost every day. When you got 28 people and you're in the middle of chaos and you just yell out the office, help, it all works out. You decide things in a moment and don't brook any objections. Don't know who I'm talking about here. But those early days, it's quite easy to establish the kind of culture I wanted with something new. Those 28 people, most of whom were accountants as it happened, but very little kind of middle management or upper management at all. So you get a real great shot at making it people-oriented, caring about people, making sure they're fairly compensated, making sure that you reinforce the company's objectives by having them share a great partnership plan there, which was originally based on our cost advantage relative to our competitors times our assets, and there's this huge amount of money that comes out of that. I think right now it's about $16 billion a year, and a small part of that goes into the partnership plan. That's just illusion, but we spend part of that advantage on the partnership plan, which everybody, at least in my era, you got paid on a little matrix with your number of years at Vanguard there and your grade here. There was a number that said you own so many shares, and it worked great. And I should say, I don't want to get too parenthetical on you here, but like so many things at Vanguard, it came up kind of by accident. And I was speaking to our staff once. We used to have parties at every $1 billion. Billion. Like 5 minutes of cash flow, 10 minutes of cash flow, I don't know. I was talking about the importance of being low cost and drawing people in, and if you build it, they will come, all those kind of things. And I noticed in the audience a kind of negative. I hear him giving all this great news, and it became quite clear to me that every time I talked about low cost, they're thinking, so that's why I'm not getting paid anything. So we set up the partnership plan, so the bigger we got and the lower cost we got, they would get a big bonus, maybe 35%, up to 35% of their compensation. Bang, one shot every June, based on the results for the previous year. I don't know exactly how it works now, but it's in that spirit. So, I wasn't sensitive enough. You live and learn a lot, even I do in this world, but not sensitive enough to the needs of the people that were. I was this great missionary preaching from this high pulpit, the bully pulpit, and not quite being as deeply involved with the people there as I should have been. And that brought me down to earth, and it was a great lesson. So, keeping the culture, I use this example when I talk to people, something I said back in the early 90s, no matter how big we get, for God's sake, let's always keep Vanguard a place where judgment has at least a fighting chance to triumph over process. And when you're down at the 28 crew member level, there's almost no process and all judgment. And you get to 16,000 crew members and $3 trillion. And the process line, percentage of business, if you will, visualize that, gets higher and higher and higher. And if you have a new boss, new chief executive, who loves process, it's going to be here. And if you have one who hates process, it's going to be here, but it's never going to be back here. It's just one of the costs of doing business, if you will. And that's why I spend so much time today trying to reinforce the culture. If I didn't say this, I will. I spoke to 300, and I'll repeat it, I guess, if I said it before, about 325, 350 people. Looks like a crowd, maybe bigger than this. Well, a lot of people here. Where'd they all come from, Tim?
Wandered in, I guess.
And just talking about the firm's values, give them a chance to see the poor old guy who's kind of shoveling around. Still interested in talking, still interested in pressing on the values that we created, still interested in letting people know from whence we came. And, we came from nowhere. And they have to know that, the years of struggle, how these values got embedded, how these investment strategies came along, and try and humanize. But it's, ultimately, that process line is going to grow a little bit every year, whether I like it or the managers like it, the chief executive likes it or not. So, I hope that after I've gone to my reward, which I hope it's a reward, you're never quite sure about that, that they will still try and carry on this spirit. But it's actually one of the most enjoyable things I do, meetings like this one, meetings like the one I had yesterday, where I can talk to real, honest-to-God, down-to-earth human beings, a phrase I've used 1,000 times. And to me, that's what every business should be about. And it's not. It's too much, as Adam Smith warned all those years ago, back in 1776. The producer better not forget that the prime objective of his business is to serve the consumer, to put the client first, to put those who are working there first, and not think of his own interest. American business is totally upside down for that. They don't do that. You know, you see good people giving their lives to companies, and all of a sudden they have a right sizing. We've got the greatest words in this world. Right sizing means out of here. You're out of here, pal. And then we eliminate health benefits like Walmart did. The people that are doing all that, you know, why do we do that? It increases the earnings, it increases the stock option value for the executives, and it makes the shareholders happy. Well, I don't believe in a world, I'll be quite honest about that. I don't believe in a world. Is it okay? Was that me?
That was you, I think.
Are we on the air? Can you hear me? No, right now. Sorry about that. Do a better job the next time. I'm only kidding. Shove that in your pocket there. We're putting the people that are doing all the company's hard work and often thankless work at the bottom of your list of priorities is simply, in the long run, stupid. Did I make myself clear? I guess I did.
Got a question from member Stephen Clark. What was one of the worst investment mistakes you made, and what did you learn from it?
Well, the worst investment mistake I ever made was doing that stupid merger. I mean, there's nothing in comparison. And the only thing that's amusing about it is that out of that catastrophe for me, personal and financial catastrophe for me, came Vanguard. So it was a good, bad mistake, if that's enough for you, speaking in the Pennsylvania Dutch mode. But I've made others, and many, many others, and don't mean to limit the number. This is not, believe me, I'm not going to stop at these next two, except for the purpose of this lecture, because I made probably 50, but the other bad ones were, I got too competitive from a marketing standpoint. I was going into the hospital. I had my first heart attack when I was 60, and somewhere about 85, I got a little greedy for marketing and decided we would create a better than Fidelity had sector portfolios. We call them Vanguard Specialized portfolios. And it was really stupid. And they're all pretty much gone now, except for one, Vanguard Healthcare. Probably the most successful mutual fund, if you take the number of assets and the performance and multiply them together, the most successful fund in the history of the mutual fund industry. So like the disaster at Wellington turning into Vanguard, the disaster at Vanguard Specialized turning into healthcare, the other funds didn't do that badly, but it didn't help them to have healthcare in doing so well, healthcare investors. And the other one is very, very, very similar. As I started, the directors put a little pressure on me, and I didn't like that. I generally pretty much ignored what they wanted done. This is not a good political formula, by the way, as I was to learn, and put a little pressure on me to get a little more aggressive. You know, obviously the market was, this is the early 90s. So I said, well, let's start a line of aggressive funds, markedly aggressive, red warnings on the prospectus kind of thing. And that was called Vanguard Horizons funds. Probably nobody in the room has ever heard of Vanguard Horizon funds, and they are all gone. You know, they were going to be short selling and doing things like that. And I can't remember all of them. I can remember only one. It's called Capital Opportunity. And we had an advisor on the West Coast that could sell short. The guy was nuts. He was a diet nut, and he was on his bicycle in the office when you were talking to him. It really threw me off quite a bit. Frank Husick, H-U-S-I-C, remember him like it was yesterday. And the fund was an utter failure. Everything he sold short went up, and everything he had long went down. This is bad. You know enough about the business to know that. So we terminated him and got our friends out at Prime Cap to run Capital Opportunity in about 1994, I think. And since then, it's been one of the best performing funds in the business. So another disaster turned into an opportunity, but it was really a lousy idea, and it was done for marketing reasons. And I tell people most of the mistakes, if not all, that I made in my career, well, I don't want to limit it too much, but were made because I had a marketing hat on. And that means you respond to the moment, and this is a business in which you should never respond to the moment. Maybe one of these moments you'll be right, but it's going to be pretty rare. Now, I don't want to take any more time on other mistakes.
Yeah. Okay.
Because it hurts too much.
Yeah, exactly. So, Jack, so actually, since you mentioned Prime Cap, I'm thinking, I've been telling clients about the virtues of indexing in that you can, it's something that outlives the lives of the managers. In some of the funds that they're in recently, I don't know if other people are noticing, but some guys are retiring, some guys are passing away. And I wonder if you have any information about transitions of mutual funds in the lives of the ordinary investors out in the world, what they can expect, the longevity, and why indexes is going to help be a solution for that as well.
Well, yeah, let me make the critical distinction here. Your clients and our clients are or should be investing for a lifetime. For a kid getting out of college and getting his first 401k today at age 20, that is going to be, I'm glad you're sitting down, he's going to get to 100 or she to 100 years old. Actually, he will probably get to 98 and she will get to 104. You know the demographics. And so they're going to be investing for 80 years. So think of active management in this way. Most people start off, let me say, conservative when they're in actively managed funds with about 3. And the average portfolio manager lasts for 7 years. And 50% of the mutual funds go out of business every 10 years. That's not 50% of the asset base, but 50% of the number of the funds. So you're talking about a lot of internal turnover anyway. But if you say that the average fund is going to be held for 10 years, and the industry data show nothing like that long in average, you're going to have 3 managers in the first 10 years, 6 managers by the time you get to 20, 9 managers, you're probably getting the rhythm here, at 30, and God knows what, 16 when you get to 80 years old. The possibility that 16 different managers, each running a fund for 10 years, are going to outperform the market than any of them will, and to say nothing of all of them, is, I think, substantively zero. Z-E-R-O. And when you think about the internal dynamics of that, why does the new manager come in? Usually because the old manager didn't do well or quit to run a hedge fund. So the new manager has to put his own flag on the portfolio, his own stamp, his own endorsement on the portfolio. And so the new broom comes in and sweeps clean. That costs money. So it's just not a lifetime investment. Where if you look at Vanguard's great promise, I hope you'll be stunned by this, that we promise to have the same non-manager for your portfolio when you're 100 years old as the non-manager you originally hired when you were 20. Think about that for a minute, and think about what fundamental good sense it makes.
Interesting. Jim?
Did I make the sale?
Jack, you've been really critical over the years of ETF funds and the rise of ETF funds and the number of funds available. One of those is just the sheer volume of trading going on in ETF funds. Could you address that briefly? And is there a good use for ETF funds for advisors who are holding them or investors who are holding those funds without selling them on a regular basis?
Well, I guess my short answer is kind of flip, Tim, and that is ETFs are great for you. Exchange-traded funds are great if you don't trade them. Think about that. But wait a minute, they're exchange-traded funds, and you can trade it whenever you want, all day long. The S&P used to say in their original ad, and now you can trade the S&P 500 index all day long in real time. What kind of a nut would want to do that? I mean, get a life, pal. Take your wife, take the kids to the park. Take your wife out to dinner, do something, play golf. If everything else fails, read a good book. It just makes no sense at all. And there really is, I think people are gradually becoming aware, two very different ETF businesses. And about half of all ETFs are held by institutions that turn them over with a fury. 70% of the spider is held by institutions, and they're going long, they're going short. They're making a short ownership of the market until they can find a real manager, real in quotes. So a lot of trading. And a couple of weeks ago, in the very up and down market week, the spider traded $160 billion in a week, and its assets are $160 billion. 100% turnover in the week. And if you compound that, it's probably 9,000% in a year. 9,000% turnover in a year. And I'm, poor Bogle, I think 3% turnover is pushing it a little bit. So we really can leave them out. They're not doing any harm, not doing any good. These people aren't, and really even relevant. So you get to the other half, which is owned by individuals. And I'll just give you some data from Vanguard. And that is, and we publish this and we're proud of it. We actually have our ETFs are just series of our regular funds. They're identical, except for the way you buy and sell them. And so we did a survey of all those people that owned our ETFs and owned a similar group who owned the comparable regular funds, which I had to think of a word for. I call them TIFs, traditional index funds. And that's the business that I started all those years ago. And in those investors were about 90% long-term oriented and 10% short-term. The ETF group was about 80% long-term oriented and 20% short-term. In other words, the number of trading short-term investors doubled. And not a bad number, but still up 100% is not necessarily a tribute to long-term investing. And I believe it's fair to say, and I think you'd probably agree with me, those of you who know Vanguard, that we probably have the best numbers about limited trading in ETFs of anybody in the business. So you can probably look at exchange-traded funds as being held by maybe something like 60% individual investors who are trying to hold them for a long term, and 40% that are trading them. And I just think trading is murder. Every study that's ever been produced, nothing to do with Vanguard, but Terry Odion out of University of Southern Cal, I think, an academic, says the more you trade, shows, defines, quantifies. The more you trade, the less you make. Well, our instincts tell us that. And now we're given something that you can accelerate your trading, and I think even worse, although it has not been clearly demonstrated, because we haven't had enough really bad times, but I think even worse, the market's starting to go way down on a given day. Let me say 3%. Seems like a lot when you multiply it by Dow Jones points, which is misleading anyway. But so the investor decides, I'm out now, I'm going to get out. And I have to wait 2 more hours to get out and redeem at the closing price. Well, that's probably not the end of the world to hold your fund for 2 hours extra. And to make matters, I think, more likely, and that is the one that can get out, the ETF trader, at noon when the market hits its crashing bottom and before it bounces up a little bit at the end of the day, gets out at the worst price of the day. I think data, if it were ever done, empirical data, would show that to tend to be the case. So it may be that the ability to trade is a big negative. And then we have, outside of the basically buy and hold, designed for buy and hold, S&P 500, total stock market, maybe total international, maybe emerging market, total bond market. When you get out of that group, that's about 5% of all the ETFs out there, although it may be 20%, 15 or 20% of the assets. And you get out and you get into the fruit and nut cake group. Now, I don't know what kind of a person really thinks they know enough about the stock market to bet that on a given day they want 3 times leverage, and guess what? They can choose it to be 3 times leverage if they think it's going up and prosper, and they can bet 3 times leverage if they think it's going down and prosper, but they can't do both. You can't go up and down and say, the records of those funds are just awful, records for investors and how investors fare. And it's become a marketing business cubed or taken to the nth degree there's a niche here. Originally, emerging cancer was one of the original ETFs. Well, first, I didn't think that was a very salubrious name. I'm just kind of a country boy.
Bad marketing.
And actually, I said something bad about him. I'm shameless. Said something bad about him that apparently got in the papers. And they wrote me this article saying, you had your chance to invent something. Don't knock our chance to invent something. And the fund went out of business in a year. Of course it did. And now we have, I think you can buy cloud computing, whatever that is. I mean, I really know a little, sort of, maybe, with Mike's help. And these funds will come and go. The failure rate is quite high because it's a business for entrepreneurs and financial buccaneers to try and make a lot of money by selling something that the public wants. Classic marketing. That has to change unless all buyers are stupid forever, and they won't be. People will learn from their own experience. It may take longer than I would like, it may take longer than you would like to observe this, but that's the direction of change, and therefore, as I see it, we're heading in the time is on our side, or to put it another way, I think we're on the right side of history, and honestly, I don't like to pander to crowds much, but I really believe you all are on the right side of history in the way you've structured your alliance.
Sort of in line with that thinking, Jack, I'm going to put a magic wand in your hand right now. And so if there were 3 things that you could do to improve the investment industry, and think of legislative, think of culture, think of training, just let the imagination roam, what 3 things would you do to change it for the better?
Well, the first and most obvious, but such a grand step, it's going to take a long time, is to create a federal standard fiduciary duty for not only investment advisors, RIAs already have it, or at least imputably. It's not written into the law, you have a fiduciary duty, but the law has been interpreted that way. But make that apply to money managers. And that's going to be a big step. It has been politically charged, and the lobbyists for the money managers don't like it. So they got a specific exemption from the Dodd-Frank Act, saying the SEC should investigate fiduciary duty, but do not investigate the fiduciary duty of institutional money managers. Do not. It's right there in the law. I'm not making it up. They're leaving out, and we're only running $16 trillion, we institutions. It don't matter much. There's another $4 trillion in the market. That's much more important, or something. And so that's going to be very hard to do, and it's going to be a life work to get it there. Even as, this is a very important point here, as the Investment Company Act of 1940 says in its preamble, investment companies must place the interest of their shareholders ahead of the interest of their officers, directors, investment advisors, and distributors. That's fiduciary duty spelled out in words of 1 syllable or 2. That's never been enforced. It's in the preamble, but the idea of the act back in 1940, my God, that's almost 100 years ago. Well, more than 80 something, and it hasn't been applied in this industry at all. They're just ignoring it. So fiduciary duty being the principle on which all of us, anybody who touches other people's money is a fiduciary. And if they don't want to admit it, they should go get into another business. Did I make myself clear there? 2 would be something very easy to accomplish and something that we are all, and I think you are all, accomplishing every day. Investor education. And an informed investor about how this business works, understanding the role of cost, understanding that investment is a lifetime job and not just a momentary job, a lifetime program. Understanding that the stock market creates nothing but subtracts from the value created by corporate America. To expand on that briefly, where does the value in the stock market come from? It comes from dividend yields when you buy in, plus subsequent earnings growth. Speculative return, paying more or less in the way of PEs, makes that go up and down like this, while this big line is just growing and growing and growing. So it's investment return, not speculative return. And all you do is turn that over to a marketable instrument that we call the common stock, which is, of course, technically a derivative. Stocks are derivatives of the value created by American business or global business. And so it takes money out. It is an industry that subtracts value. And if people understand that, understand the role of that over the long term, understand the role of costs, understand the role of spending too much time hearing about yesterday's winners, reversion to the mean, there aren't tomorrow's winners. I have a whole chapter of charts about that, about 10 charts of the most notable funds of the last quarter century in my book. Not character counts. Clash of the Cultures, those two C's keep getting me mixed up. And this is the most recent one. God, is he getting that old? And showing reversion to the mean of, Bill Miller at Blake Mason Value, Fidelity Magellan, T. Rowe Price Growth, had a huge run like this, and then they go like this relative to the market. Look, you superimpose all these charts, these 8 or 10 funds on one another. Oh God, there it goes again. Well, this is still here. We on now? All right. We'll do it your way. It looks like the Himalaya Mountains. Yeah, one of them's peaking here and going down, one's peaking here, one's peaking here. One U.S. growth fund of ours peaks twice. Most people only peak once, and that's very unfortunate. That fund was just mishandled. Shame on us, or as they say in this day and age, are bad. And that is what has drawn me to this. I won't say any more about investor education. I do have one other point I want to make. Your third one, or my third one. But if people would just realize they're being misled by looking back, and the performance doesn't repeat, that would be a huge part of the educational experience. Reversion to the mean is a rule of the stock market's life. It's way above fair value and way below, and back and forth and back and forth. And they ought to know that, they ought to understand it, and they ought to ignore it. So that's where I would go there. In the mutual fund industry, I'll make my third point. We have the most somnolent boards of directors in the history of somnolent board directors, which is basically everybody in America. And maybe I should broaden this beyond the mutual fund industry. Directors have to wake up and make sure their companies are run in the interest not of their managements, and not in their political contributions, and not in their executive compensation, but in the interest of their stockholders. And that's true of mutual funds, and mutual funds are just in the dark ages as compared to the right structure. There have to be more vanguards, and will be more vanguards, but I say that, someone said I was a leader. I said, well, wait a minute. Doesn't the leader have to have followers? And we started Vanguard 40 years ago and have yet to find our first follower to adopt that structure. But it's going to happen. And I've tried to make it happen at Putnam and failed. I tried to make it happen at IBM, which had their own little management company for their retirement plan. And they sold it to one of the New England banks for a lot of money. We offered them nothing. They were a little surprised because they wanted to sell it for something. I said, you can sell it for something, but we will give your fund shareholders the break, and you want to give IBM the break. And they did. That's the way the market works. So we really need a much stronger sense of a kind of fiduciary duty here, but a little bit different. Director's responsibility. And as the great Buffett would say, we've got to turn those Cocker Spaniels into, I don't know, what's that big dog that eats everybody up? Rottweiler. I don't think he used Rottweiler, but I like that much better than what he did use. Cocker Spaniels into Rottweilers. And you just don't get even a hint of that. And, but that's the direction of history, and will be the direction of history, because a little bit like as the electorate changes, the Supreme Court listens, They may not appear to, they may not want to, but sooner or later, the public will be served. And in this case, the investor will be served. And, you know, it's a little bit, I say this with a great deal of confidence, but I won't say I don't have moments of despair. You know, it's going too slow for me. Now, I should tell you, in all my life, I've never run into anything that went too fast for me. So, those three things. And you can do them, Chip.
Me?
Yeah, lead the way.
All of us lead the way, right?
Yeah. Jack, your criticism of active management is well documented, as you've mentioned here today. But we've seen Vanguard expand further into active management funds. Do you see a role for actively managed funds, especially as we see expenses for some of those funds become much lower, which has obviously sunk a lot of active management over the years?
Well, Vanguard is a huge advantage in the cost of our actively managed funds. And you know, the typical manager is fighting a hurricane with his costs or her costs or their costs. The Vanguard funds are fighting kind of a stiff breeze, very different thing. And the actively managed funds have expense ratios that can run into the, well, actually I looked at this the other day. There are, I think, 200 funds, roughly. Don't correct me, Mike. We'll fix it tomorrow. 200 funds with expense ratios under 0.25, and one of them is an actively managed fund, one of the really low-cost funds in the business. And that would be Vanguard Equity Income Fund. It's 23. So we have plenty of funds in that kind of range. And it's arguable that they have a good chance of doing better than the index funds, but they definitely do better than other actively managed funds simply because of lower costs. And if you see the equation, I had my idea for Vanguard from the very beginning was relative predictability. Wanted funds that didn't depart from their track, their kind of competitive peer groups. Because if you depart, like all those reversion to the mean things I told you about, you get somebody who's very good and the money comes in, and then they turn bad, it's inevitable, and the money goes out. So I liked relative predictability, and years later, we, the industry, stole the calculation, much more sophisticated, R squared, or coefficient of determination, how much of the fund's assets are determined by the returns of the market it's in. And to just give you one example, we call Vanguard a Wellington Fund an actively managed fund. It has an R squared of 98 with its index, which is 35% corporate bond index, investment grade corporate bond index, and 65% S&P 500. And it tracks that 98%. So I do ask myself, why are we paying money for 100% of the fee on 100% of the assets when we should only be paying anything for 2%? This argument has not gotten me anywhere. If I was running that place, I can assure you it would get me somewhere. The management company would be paralyzed with fear, as they were when we started cutting off. We had probably 40 fee reductions in 5 years when Vanguard started, fee reductions with Welling. And what did they say? I'll tell you what they said. Yes, sir. Figure it out. You want to keep the business, or do you want to get paid a fair price? And actually, I don't know if you really need this information, but I was always, this is one area, I apologize for all my stupidities, this is one area I was reasonably smart. And as I could foresee an awful lot of growth for these funds. So I'd say, well, we want to reduce the fee from maybe 75 basis points at that time to 50 on present assets. Say it was $300 million. But when the fund gets to $1 billion, we're going to 2 basis points. We're so far away from 2 billion, it was almost as if they weren't paying attention. And the next thing you know, the fund is 20 billion. And they're still making an awful lot of money. That's the crazy part about this business. That percentage fee makes basis point fee makes just as much sense in the mutual fund industry as it does in the business of RIAs, which I take it you feel is none.
Yep.
How are we doing for time?
How are we doing for time? 10 minutes?
10 minutes?
8 minutes.
8 minutes? Okay.
Do we have any questions from the audience? Go ahead.
Where do you see the
future of robo-investing?
I'll repeat that. So where do you see the future of robo-investing?
What price glory? What low price glory? I have to say, my friend Bert Malkiel, professor at Princeton, we've known each other for a long, long time. He came on our board a couple of years after we'd started the first index fund, which is an idea he mentioned in his book, Random Walk Down Wall Street. And we agree on almost everything. He's in there as a commercial, I think it's Wealthfront. Michael? Wealthfront?
I believe so. Yes.
What was it?
Yes.
Well, yes, he was confirming.
Well, that's what I said. You don't have to, don't have to confront me. I confess to some deep, deep reservations about robo. You know, robo, it's a little like the stock market we live in. Everything is done on computers. And you push the wrong button, it's a little bit different, but you push the wrong button and a firm goes out of business. So they just bought 400,000 shares of stock instead of 40,000 or something, and they don't have any money to make good on it. So I think human intercession, I think people are looking for, and people use this term in a pejorative way, hand-holding. I think most people need a little hand-holding. And I don't know what kind of cold hand old robo does. But I think, if we enter into a time where there's a great deal of market volatility again, which we will, I don't know when. We had a little bit of it a couple of months ago, a month and a half ago. I think an advisor who wants to use robo, if that isn't a contradiction in terms, that probably works okay. Because to me, investing is not very complicated. You can't do it in fixed dollar savings because the risk is that you'll have nothing after adjusting for the cost of living when you retire. So that leaves you, to me, with stocks and bonds. And so the question is then, how much in each? Asset allocation question. And you can get it wrong. Nobody really knows the right answer. God knows I don't. But there are certain intelligent ways of looking at it, which will probably mean that you'll do better than you would otherwise do. And that's the business I think we're all in, not promising miracles, but promising a little edge over what you might do if you were left on your own, or even a big one in some cases. So I'm not totally familiar. I know what the trend is. I know who the firms are, but I know a little bit about the formulas they use. But I'm from Missouri again on that one, and we'll see. But I think it's going to be a hard business, and not prove easy for clients.
There's been some volatility in the recent year, not so last year, and I'm just wondering, and this is actually a question from one of my clients, whether you think that the markets now are more able to more frequently adjust to over and under evaluations than they have in the past, or do you think it's just more of the same going forward?
Well, I think there was a huge learning experience out of the great crash of 1999 to 2002. And we had to learn that because the valuations were ridiculous. If there was ever a time to think of a reallocation because of market timing, to call it what it is, at the end of 1999, it was the perfect time. And I actually remember saying, right about that time, Don Phillips of Morningstar, we do interviews together, that he's interviewed me many, many times, and he talked about the markets, and I said, look, stocks are selling at 40 times earnings, the dividend yield is 1%, you'll be lucky in the next year to get a return of 1 or 2%, next decade to get a return, I don't do years, in the next decade to get a return of more than 1 or 2%. And here I am looking at stocks at that level, and bonds are locked in because of their interest rate at about a 7% return over that 10-year period. So it's really easy to think about reallocating in a substantial way, which I did. Now, I'm never smart enough, or maybe I am smart enough, not to do it all, but I cut down from about 75% equities to about, I think, 30% equities. And it was fabulous, but it just worked the way the numbers required it to work. Those opportunities are once in a lifetime. We're not there now, partly because stocks are not that highly priced, I believe, a little bit high, but not bad, and partly because the option in bonds is awful. I mean, this is the hardest time to invest I have ever seen, because you don't have much of a choice between stocks and bonds. Now, I will always keep bonds, naive as I may be, as a kind of anchor to windward, or whatever you want to call it, dry powder, just to protect me from my own behavioral failings. But I haven't changed my allocations. I'm quite conservative, probably overall 40% bonds, 60% stocks. In my personal account, I'm doing a lot of stuff with trusts and so on, a little foundation. My personal account's probably 80% municipal bonds, intermediate, and some short-term, or I should say some limited maturity, and 20% stocks. And I'm happy with that. The stocks are, of course, all indexed, and the bonds, our muni funds, have correlations that are squared again of 99 with their indexes. 99, I mean, that's a correlation that you can die for. And I like it. I don't want to be different. And that attitude has changed a little bit there, and that's what explains the ability to bring out, or the interest in bringing out new funds. But I think the standard for any new fund that we bring out, I hope I'm not offending anybody here, well, not here, don't tell back at the office, is the standard is, what reason do you have for believing this new idea will outperform the stock market index, the S&P 500? And I can't imagine what that rationale would be. I mean, no one has ever done it over an investment lifetime before. And I think a problem with bigness is you have an advertising department. What do they want to do? You want to guess? Spend a lot of money on advertising. You got a marketing department. They want to spend a lot of money on marketing. You generate internally ideas because it's people's job to do that. And you know, the great naysayer in the sky, that would be me, would just say no, 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 no. And but when I had an idea, of course, it was yes, yes, yes. God, I am so fluent. Protect me for a couple of more days, please. But confession is good, isn't it? Your Honor?
I guess I can't resist this, but I think it's fairly widely known, Jack, that there's an active manager in your family. And I wonder if that makes for interesting conversations over the Thanksgiving table.
This reporter from Money Magazine, they still have this thing, Time Magazine, called 10 Questions for John Bogle. And she phrased it just the way you did, Chip. Understand your son is a hedge fund manager. How's Thanksgiving? And the answer is, Thanksgiving is fine. Am I supposed to tell my son how to make a living? He's very smart, very quantitative. He's a big hedge fund following and a small cap mutual fund. And belying everything I warned him about, I opened Morningstar. I had Mike send a copy of it up to him a couple of days ago. And his small cap fund in the small cap arena is first for the year to date, first for the last year, first for the last 3 years, and first for the last 5 years. And I said, what do you think of that, John? He said, we're having a terrible October. This would have been, we had a terrible October. This would have been through September. So I get the date out and see how badly he slept. But, you know, fathers aren't supposed to tell their sons what line of business to do. And for God's sake, he does it well. He has a different, he says, we had this conversation, I think I mentioned it to Chip before, and I used to needle him a little bit about it. And he'd say, look, I'm making a lot of money for my clients, and therefore I'm making a lot of money for myself. What's the matter with that? And I said, nothing the matter with that, John. He has quite low fees. He runs mostly a market neutral fund. He runs a hedge fund in a world where there are very few hedge funds. You know, a hedge fund is a fund that's 50% long and 50% short. That's what the A.W. Jones, the first hedge fund, was. And he does a very good job at it. He probably earned the last 5 or 7 years maybe a 5 or 6 rate of return on a totally market neutral portfolio, and he's supposed to beat the T-bill. Well, of course, now it's getting a little bit easier to beat the T-bill, which as far as I know pays nothing. The low target, John. Get a tougher one. But
So that's how it goes at Thanksgiving, huh?
but he does things. His fees are much lower than the usual hedge fund thing. It has an incentive built in before he gets the extra 1%. I think he has instead of a 2% carry, as they say. 2% carry. What's the carry? God, it took me years to read it. It's our share of the money, pal. And it's too much. So I think he's running a good business in a responsible way. And more power to him. And he's a great kid. What more could a father want?
Exactly right. So,
Well, Mr. Bogle, that's really all the time we allotted today, but I just want to thank you tremendously for coming out and speaking to our group today. It was very educational, and we really appreciate it.
Thanks, Tim.
Thank you.